Greetings, everyone, and thank you for joining us today. Today marks our second Unitarian Forum this fall, and we appreciate your being a part of it. My name is Wayne Jennings, and I'm the host for today's discussion titled, The National Economy, Future Bumps in the Road. It's obviously a timely topic. We organize these forums as a congregational service to the community to support social action and to encourage individual and collective growth for all of us here. I'd now like to introduce the coordinator for today's forum, Jean Martin, and she will introduce the topic and our speaker. Jean?
Good morning. I'm so glad you can join us today. I bet you feel like I do. When I compare the news of my bank account, I wonder what's next for the economy? How is the national picture fitting in with my life? Our economy is swimming upstream in rough political waters. How can we steer the economy out of the pandemic? What might happen if the US government shuts down? These are some of the questions currently facing all of us. Some housekeeping notes before we start. We'll have about a half an hour for speaker remarks and then time for questions and answers. Please use the Q&A box, not the chat box, to pose your questions. We appreciate your sticking to questions, not comments. If you'd like to receive weekly email notifications of future forums, or if you have ideas for future topics and speakers, send your name and email and ideas to forums@uucleveland.org. I'm pleased to introduce our speaker, Dr. Mark Snyderman. He's a professor at the Case Weatherhead School of Management and former executive vice president of the Federal Reserve Bank of Cleveland. He has a PhD and master's from the University of Wisconsin and a bachelor's from Case. Mark, we welcome your presentation this morning.
Thanks, Jane. Great to be with everybody. I spoke to this group a few years ago, well before COVID, well before we could have imagined the concept of COVID and what it might do to our personal lives and our families. So I'm going to talk with you this morning about what I call the COVID economy, and I hope to paint a picture for you of how an economist looks at the way the COVID has affected our economy. I'll look at that from several different points of view. And then I'll talk a little bit about kind of where we're headed. And as always, I'll really look forward to the half hour or so after my remarks where we can talk among ourselves. You can raise questions and we can have some interaction about that. So I've prepared some graphs for you. I wouldn't be a professional economist if I didn't have any graphs. And I'm going to share my screen with you and show them to you. So let me do that. First, I have to find my screen sharing button. Second. So, Jean, did you share the screen with them, or do I have to do that?
You have to do that.
You have to do it.
Yeah.
I have to do that. Okay, so let me find the place where I do that. Here we go. Okay, so can everybody see that and hear me? That's the two things that we want to do. I think
Yep.
that's
Looks good.
okay, great. So COVID economy, future bumps in the road. So here's what weighs 1/10 of a milligram and yet can destroy $8 trillion worth of global GDP. What measures 75 nanometers? A nanometer is 1/1000th of a meter in length. What measures 75 nanometers and yet can separate families and neighbors? Well, the COVID-19 virus. That virus is so tiny, and yet its devastation has been so gigantic. What's more, we'll be coping with its repercussions for quite some time. So in our own ways, we're all COVID long haulers. So that's kind of my message is we're going to be dealing with from an economy point of view, the tail of COVID for a while. So I spoke with this group when the group was called the First Unitarian Church in 2018, so almost 3 years ago to the day. And at that point, we were dealing with what I was calling Trumponomics. And we had a new President Trump, and he had a whole different agenda. And there were lots of wild things going on with the economy, and I think in particular trade policy at that point, because there were a lot of tariffs that were being introduced and tensions were being raised internationally. It was causing quite a lot of chaos. And now we have COVID causing chaos. So let me start with this picture. This is a picture in blue of the unemployment rate in our economy, and in red of the total number of employees that are on the payrolls of businesses. And you can see at the time that I was speaking in 2018, the economy had been recovering from the 2008-2010 global economic crisis, where unemployment rates had spiked up. And then you see this long, steady progression of the unemployment rate coming way down to roughly 4%, if you look at the left-hand side scale there. And on the right-hand side scale, you see job creation and employees being added to payrolls just on a pretty consistent basis. So the economy, had actually been doing quite well at that point. If you look at it from the perspective of output, which is real GDP, the blue line shows the rate of, shows the level of output in the US after you take inflation out of the picture. This is real goods and services. And again, this 2008-2010 period, you see the slump in GDP, and then you see this long period of economic growth. And the dashed red line is economists' estimate of what the economy is actually capable of producing if we're fully employing all of our resources. So you can see how large the slump was, because it really pulled us well below that dashed red line. And it took a number of years, but just as we were speaking in 2018, the economy had come back to the point where it seemed as though we were at what many people would have considered full employment for that time. Now, the Fed, which is sort of the primary governmental organization that's sort of charged with managing the business cycle, if I could put it that way, has an inflation target of roughly 2%. And I've drawn that in a dashed line across this picture. This is a couple different ways of measuring the inflation rate. The red line is the familiar consumer price index, and the blue line is actually the one the Fed uses. They can diverge from time to time, but they generally follow a pretty similar trend over longer periods of time. And you can see here that as our economy was reaching this so-called full employment state, the inflation rate was around 2%. And at that point, the Fed would have been probably tightening up monetary policy, because it had been very easy. It had been extraordinarily easy during the years leading up to this to help encourage the economy to get back to full employment. So this is all kind of what the environment was like as we were heading into COVID. So I want to just kind of remind you kind of where we were. We were actually in a pretty good place before the arrival of COVID. And then what happened? Well, take a look at one way of thinking about employment. So I drew these charts in a way to set whatever the level of employment was in June of 2009 to be equal to 100. And that's why you see these two lines, blue and red, equaling 100 back in June of 2009. So that's our starting point. And then everything else is relative to that. So you can see kind of commencing from that point, employment growth up to this, sort of full employment level that I was telling you about in 2018 continued to grow. And then look what happens when we hit I think this is probably going to be about March of 2000. And then all of a sudden, this huge, like tremendous plummet in the level of employment in our economy. And then I depicted the same for the manufacturing sector because it had a pretty steep fall off as well. And then, of course, things are now on the upswing after the arrival of the vaccine. And it's been easier for people to associate together. Things have been coming back, but you can see we're still well below the level that we would need to achieve, even if we were to get back to the pre-pandemic levels, whether it's the manufacturing sector or the non-manufacturing sector. We still have some ways to go to get back to that level. And this issue about the state of the labor market is a critically important one in trying to assess kind of the health of the economy and the welfare of people, because we still have some ways to go. Here's another picture of employees in the dashed red line, the growth in employment trending up, and then this plummet again. And then I've now juxtaposed this against the unemployment rate. So that unemployment rate that I showed you before, that was about 4% in 2018, continued to actually drift down a little further. It went to about 3.5% before this tremendous spike up with COVID, when everybody essentially, stopped working for a period of time. Now that unemployment rate has also come down pretty, dramatically, but again, you can see we're still above 5%. And so if you want to think about 3.5% to 4% as maybe an attainable level for the US economy, kind of like where we were just before the COVID, again, by that measure, we still have some way to go. So here's kind of, a way to think about that, how far we are from the peak in employment, some room to grow there, and how far down we could drift a little further with the unemployment rate, maybe still some room to grow. This is from the perspective of all employees, again, in the blue line. And another way of thinking about employment is the fraction of the population who are employed. We had been at a much higher employment to population ratio before the arrival of COVID than we are now. So again, by that measure, another way of thinking about some more room to grow. And finally, the labor force participation rate. This has been, kind of a vexing issue because we were, a little above 63% as far as labor force participation rate. That percentage may not, mean anything to you. There's no reason why it should as a number, but just to give you kind of a benchmark of the working age population in the US, how many people were either employed or looking for work. So they were not working, but looking for work. So they're participating in the labor force. Well, of course, that plummeted dramatically in COVID, and it's bounced back kind of like employment levels have and the unemployment rate has. But look, it's been kind of stable down here, a few percentage points below where it was before COVID. And that means that there are still some millions of people who are not only not employed, but not back in the labor force looking to find work. And so that's one of the sort of vexing issues, is the shortage of employees that many businesses are seeing. If I want to show you where the economy kind of more broadly is without looking at the labor market, I can take you back to this picture with the red line that shows the so-called potential of the economy, where we could be if we had full employment of all of our resources. And you can see, once again, we fell very sharply below that red line with COVID. It has a different profile than you see back at the 2008, 2010 global financial crisis kind of recession. That one was a more typical sort of slump This one was a very sharp spike down because of the unusual nature of the event. The pandemic itself just caused people to, just stop avoiding one another. But again, a much sharper bounce back. But you can again see we've got a gap between where we are and where we need to be. I'll tell you a little bit later in my remarks what the projections are. The projections are we should close that gap over the next several years, but I'll get to that fairly soon. So I mentioned the Fed earlier. What's the Fed been doing? Well, one way of gauging Federal Reserve policy, certainly not the only way, but one way is looking at short-term interest rates. And the short-term interest rate that the Fed controls directly is called the federal funds rate. It's the rate the Fed can directly control, and it's the rate at which banks can borrow and lend money to one another on a short-term basis. You can see over this really, really long sweep of time that the level of the federal funds rate has been coming down, even though it has its peaks and troughs as the Fed raises and lowers it to speed up or slow down the pace of economic activity. It's had a long downward trend. And one of the most fundamental reasons for that is that the Fed has been slowly over the last several decades wringing inflation out of the US economy. For those of us who can remember, back into the 70s and the 80s, the inflation rate was, much higher than it's been in the past decade, for example. So back in the 70s, we had double-digit inflation. In the 80s, it was not uncommon to see rates around 5% or so. And slowly, that inflation rate has been worked down by the Fed. I mentioned earlier they have a target of 2% inflation, kind of average over the longer term. And indeed, they've been able to be successful with that over the past decade. So that means that the level of all interest rates in nominal terms keeps coming down as long as the rate of inflation keeps coming down. The rates of interest that we see keep coming down. And so that's the reason for that. And the last bump that you see from 2015 to 2020, that's this period where the Fed had kept interest rates at rock bottom for a while after that global financial crisis. You could see from 2010 to 2015, interest rates were kept exceptionally low to help the economy overcome the drag that was induced by that very severe recession. And they had begun to raise that interest rate slowly and then kind of steeply as we were getting near. So 2018, I think I mentioned to you before COVID, as the economy was closing in on full employment, the Fed's strategy is, to kind of raise interest rates to slow the economy down as it approaches full employment so that we don't get an overshoot, so that we don't get that rate of inflation shooting well past 2%. So that's what the Fed had been doing. Just heading into COVID, they had just been easing off their tightening cycle. So you see that Fed funds rate coming down a little bit. And then when COVID hit, they immediately dropped it to the floor again, because it was pretty clear we were going to be in for an exceptionally poor period of economic performance. So that's why you see that down at the bottom. And then what? So here's a closer picture of that, the really steep drop in that Fed funds rate starting in March, hit the floor, and then it's just been kind of sitting down there on the floor all the way through till today. It's essentially been at zero. Now, when I look at that picture, it reminds me of something like this, which some of you, may recognize as kind of like an EKG on a patient not doing very well. And that's kind of what the Fed's attitude is when it's doing something like that. Kind of looks like that chart. So that's what the Fed's been doing. And then I'll, kind of talk about, well, where are we likely to be? What else are we seeing? What's going on and where are we headed? Well, a big issue is what's been happening with prices. So here's a couple of pictures of the consumer price index. The dashed red line is, or I'll start with the blue line. The blue line is the regular CPI. It's a kind of market basket of goods and services that people like us would typically buy. And the dashed red line is when you take food and energy prices out. Now, people always say, well, why do you want to take food and energy out? Those are important. Everybody has to buy food and, you know, use energy, so it doesn't make sense to take them out. Well, economists take food and energy out of the CPI because those prices are really volatile. They go up by a lot sometimes, they go down by a lot sometimes. And on average, they kind of wash out, the ups and the downs wash out. So at any particular time, if you're looking like in January of 2015 or 16, you can see the CPI itself is increasing like hardly at all. That blue line is down at 0. But that's because there was something unusual, disturbances going on in either the food or the energy markets at that time. And they were holding the overall inflation rate down. But it was clearly going to prove to be transitory. And indeed, you can see the blue line working its way back up again. If you look at that red dashed line, it's a much less volatile time series. And so economists like to keep their eye on that one because it gives us a true sense of a more underlying picture of what's going on in inflation. So you can see those lines are kind of trending along at 2% all the way until COVID, and then prices fell. They slumped by a lot, and that's because nobody was buying anything, right? We were in a really deep recession, so the inflation rate fell. And then once economic activity ginned back up again so quickly, all of a sudden we hit a lot of supply shortages, a lot of really difficult supply chain issues as everybody wants to start buying goods and services again. And the supply side of the economy had been shut down. Companies had stopped producing various items, inventories had been depleted, and companies expected demand to be relatively weak for a long period of time. So as people were caught off guard, I mean, it was a very good thing, clearly, that the vaccines came along as quickly as they did, but most businesses had not planned for that. And so demand surged and put a lot of pressure on prices. And you've read a lot of news stories about lumber prices and prices for many other kinds of goods and services that you and I buy. And that's put a lot of upward pressure on prices. You also kind of a technical point, but one that I think you'll grasp intuitively, which is with inflation rates really low temporarily, if you compute an inflation rate as the change from the level you had a year ago, like the year-over-year change, the fact that prices had fallen so much meant that just if prices go back to kind of where they were a year later, you're going to get a big jump up in the way that you calculate that inflation rate. So part of this blip that we're seeing with the inflation rate spiking up the way it is kind of a bounce back effect from the drop in inflation that we had a year ago. So I think a lot of these inflation issues that we're seeing in front of us right now are going to go away, partly because of the statistical artifact in the way that they're calculated, but more fundamentally, as businesses are able to rebuild their inventories and the supply chain disruptions get sorted out, that'll start taking some of the price pressure off. A big caveat in all of this is the difficulty that employers are having finding staff, finding employees and people to do all the work that they could do given the strong demand that they're facing. And that's dragging out the time that it's taking to rebuild inventory. And, if you're in the service industries, it's not a matter of inventory, it's a matter of being able to serve customers. And a lot of employers are having difficulties serving customers in the service sector simply because of issues with getting enough staff. and that's also keeping price pressure up. So this is kind of a lingering issue and could be a little bit of a troublemaker in the period ahead. And it's one of the reasons why you'll see in a minute that the Fed is now, maybe moving forward a little bit its timetable for when it's going to start into its, I'll call it its tightening cycle, but a better way to think of it might be to stop easing policy so much and start shifting back to something kind of more neutral. I think they're paying a little bit more attention to some of the price pressures that we're seeing in the economy today. On the financial side of the economy, we're all quite aware of the stock market boom. Here's a picture of the NASDAQ composite index, and you could kind of draw an exponential curve through that thing after the global financial crisis. The stock price index, gradually trending up, but look at the rate at which stock prices have boomed after COVID. The most fundamental explanation I can offer you for that is just how low interest rates have been, because with interest rates being rock bottom, people who have money to invest are looking at rates of return, and the rates of return on really safe investments are quite low. And so people are a lot more willing to go out on the risk spectrum of financial assets and pay more for assets, whether they be stocks or riskier kinds of bonds. They're willing to pay more for them because they can't get a return, in a riskless kind of asset. So they're willing to pay a little bit more, and that's why these stock prices have gone up, and why the yields. So another way to think about this is the dividend yield on stocks is, come down a lot, but it's still higher than what you could get like on a CD or something like that in a bank, a relatively risk-free kind of asset. Another picture of that is looking at, say, corporate bonds. When financial conditions are really easy and people expect them to continue to stay easy, you're going to see that the price of risk taking comes down. And that's what these pictures show. The blue one is the yield on corporate bonds. You can see that these are investment grade bonds, BAA bonds. They're not AAA bonds, but they're still investment grade bonds. And before COVID, you could get like 5% rates on bonds. They've come way down to closer to 3%. And the red line just kind of shows you the spread over a 10-year treasury. And so you can, these are paying like 2% more than a treasury. So people are willing to buy these kind of bonds to get a higher yield than they could get on just buying US government treasury bonds. Here's another picture, BBB bonds, and they're spread over treasuries. So these are also investment grade, but even lower. And the red ones are the riskiest bonds, CCC, these are junk bonds. And you can see even after, so initially with COVID, there's a big spike because people are worried that companies are going to go bankrupt. So they don't want to go anywhere near buying junk bonds. And the interest rates on them go really, really high, like up to 20%. But then people start saying, well, hey, look, it looks like the federal government's going to support the economy and the Fed's going to support the economy. We're going to start buying these things again because we think companies are not going to go bankrupt so readily. And you can see the interest rates on those things came down a lot as well. So people have been willing to take risk in this environment. I'm going to skip over my trade picture and go right to the federal government. So the red line is federal debt held by the public, meaning how much debt is the outstanding. And you can see that thing had been growing tremendously after the global financial crisis. As the federal government issued a lot of debt to help to support the economy. And then once again, after the onset of COVID, tremendous amount of government spending financed by debt to support businesses, to support households during the pandemic. And it's continuing to grow. And we all know that the president is working on a $1 trillion infrastructure proposal and a much larger package to follow that would have tremendous amounts of debt issuance involved as well. The blue line is assets held by the Federal Reserve. So the Fed stepped up its asset purchases, a lot of which are government debt after the global financial crisis. And you can see once again, after the onset of the COVID, the Fed once again dramatically stepped up the pace at which it's been buying assets, primarily Treasury securities. So there's a tremendous amount of support that's been coming from the federal sector, debt financed. So where are we heading? Well, the Kansas City Fed has a labor market conditions index. And you can see by their measure, they've got the labor market kind of pretty, doing really well. When this thing is above zero, it means that the labor market is improving. And so they've got us back above zero, and conditions in the labor market are positive and moving forward. Here's that unemployment level again in red. This is a level of unemployment, I should say. So millions of people who are unemployed, and we're down to a little over 8 million. We were around 6 million before COVID. So there's still a couple million more people unemployed than there were in that so-called full employment economy. The job openings index, has really been now that we're kind of past vaccines. You can see starting in January 2021, job openings have surged. So companies are definitely hiring, and there's still these millions of people out there. We just don't have enough matches between people who are out looking for work, don't seem to be matching up well with the opportunities that companies have. They're either not in the same geographic location, the skills aren't matching, or the compensation packages that employers are offering for the openings they have are not matching the needs and expectations of the people who are looking for work. It's a whole mixed bag of reasons why we still see unemployment, significant amount of unemployment, despite the fact that job openings are strong. Prices, the consumer price index, I set this to, this is the level now of prices. I set it to be equal to 100 in the year 2001. I just want to show you the price level. It keeps drifting up. The Fed has this 2% inflation target. So the way I want you to look at this picture is, if we started in 2001 in November at whatever the price level was, and we grew at 2% a year, we would kind of be growing along the rate of this black dashed line. And we've been fairly close to that. The less food and energy price index has been running slower than 2%, and the actual CPI has been running, slightly above to on that thing. So from the Fed's point of view, the economy has been rolling along this sort of 2% line. But as I mentioned, we're in a period of spikiness. The labor market is improving. The Fed's now got to go through this complex calculation about, is it time to start easing off this big expansive monetary policy that we've been pursuing, because things are getting better. They're getting better fairly quickly. And we don't want to get into an inflation problem by keeping conditions easy for too long. And so here's the Fed's projection about where the economy is headed. If I show you the blue line, what that tells you is for the near term, like this year, 2021, They're expecting the economy to be growing somewhere around close to 6% as we close out the books for this year. And then this growth rate of the US economy will be slowing down. Still positive momentum. We probably have the potential to grow on average over longer periods of time at about 2% or so. And so you can see we're still staying way above that, but things are going to start slowing back down as the extraordinary monetary and fiscal stimulus start wearing off the US economy. We'll start getting back toward more normal rates of growth. Until when we get out to 2024, we're getting back to about 2% economic growth again in their view. The unemployment rate would be in green, so they've got that coming down sharply again to about 3% next. No, let's see, that one's on the right-hand scale. Sorry, the green unemployment rate. So about a little, around 3.8% in 2022, and then in 2023 and 2024 down to about 3.5%, which is kind of their estimate of where the unemployment rate would settle if we're back at full employment. And then finally, the inflation rate in the dashed red line from this kind of transitorily high rate of around 4% this year, quickly falling back down to close to this 2% rate that that they've got targeted, kind of settling back down into that by 2024. So that's kind of where they see things going, and I think you'll see most private economists' forecasts clustered around these projections. Some have things getting close to those 2024 conditions sooner than the Fed sees. Some see later. Some see more risk around inflation staying higher for longer, that sort of thing. But this is kind of a good middle of the road way to think about how most economists are expecting the US economy to unfold in these dimensions over the next few years. And the Fed funds rate itself that I likened to this EKG that was flatlined, well, the projections there, these are the Fed's projections, what they think based on their outlook, which could change, but if the outlook stays the way they think it's going to change, you can see them starting to lift that Fed funds rate off the floor toward the end of next year, and then gradually ramping it back up close towards 2% by 2024. That's not a really, big range to go over a couple year period of time. It's a pretty slow, it looks like a sharp increase here, but the scale of it to get only to 2% over a couple years is, a fairly easy lift off from the floor. But that's kind of, that's where they are. So, I'm trying to give you a picture of how things looked before COVID, what COVID did, some of the issues that are in the mix now, and how you might think about economic policy unfolding, at least from the Fed's point of view. I think some of the real lingering issues center around the labor market. They center around people's attitudes towards work. A lot of what we're seeing in the labor market, shortages with teachers, shortages in frontline service workers, a lot of difficulties in people wanting to return back to their pre-COVID life. Employers trying to cope with that. I think we're going to see a very different kind of work environment emerging over the next couple of years. And it'd be interesting if you want to talk about that some more during the Q&A period. I think that would be a fascinating topic. So I look forward to talking with you about that. I'm going to stop my screen share now and turn it back over to Jean, and we'll see where we go from here.
Mark, thank you for an excellent presentation. I know I speak for others when I say we all learned important information about our national economy. So it's now time for questions and answers. Please look for the Q&A button on your computer or mobile device and type in your questions. If your question is chosen, we'll recognize you by your first name unless you hit the anonymous button. I'll now turn this over to Debbie Wright and Laura Imbernoni, members of our forum committee and co-chairs of our Q&A session.
Thank you so much, Mark. And I have to say, you've intrigued me with that last statement. And as it happens, we have a question that's very basic and kind of a wonderful question to start us off. And then I'm going to add something to it. We have Jim asking, what actually caused the recent manpower shortage in segments of our economy? And then, of course, I want to ask you, what do you see happening in the future? I know of a situation where somebody was working in a restaurant and they were offered a deal to begin employment there. So they had a signing bonus to begin employment. Is that an example of what we're going to see, that employees will have quite a bit of power moving forward? So Jim's question first, what actually caused the manpower shortage?
Well, initially, the manpower shortage was just the fear that people rationally had about being in close proximity to other people. And one of the unusual features about this recession is that it was focused primarily or to a dominant degree in the service sector of the economy rather than in the goods producing sector. Most recessions are really highly visible in the manufacturing or goods producing sector of the economy, because that's the place where companies produce goods and services for inventory. And then when there's some kind of a fall off in economic activity, what firms do is they stop production and they just sell out of inventory for a while until the demand resumes. And it's that shutting off of production, shutting off the third shift or the second shift and really paring back, where people get laid off. And so we see much bigger dislocations in the manufacturing sector. In the service sector, so many things that we do, we just sort of continue on business as usual. And service sector typically doesn't fare so poorly during recessions. But in this recession, it was completely the opposite. I mean, initially everybody stopped working because they were just afraid of being together. And then there was such a demand for so many kinds of products that people needed during COVID that companies, they did many things to try to keep the workplace environment safe for people to come back to work. But if you think about services where people have to be very close together to get the service, whether it's a salon or a barbershop or education, teaching in the classroom, so many things where we're physically together, eating inside restaurants, that took a really big hit. So it was the service sector that bore the brunt of it. And as we've come back, I think the service sector is still the one that's struggling more relative to the manufacturing sector in terms of people feeling that they have a safe work environment. So employers have been working really hard to try to get people back to work. And what they've discovered is that many people have moved on. Excuse me, they've used this as an opportunity to kind of reassess their work life and kind of what they're doing with their lives. And it's really pretty.
What are they doing? What are they going to do? What do you think?
Well, I don't know. I mean, so it's a whole chain reaction. I mean, some people, if you have children at home, and up until recently, you've been struggling a lot with being in, how kids haven't been in school. So a lot of parents have been, at least one of the parents, staying home to help with children. And then schools, they've been having a lot of difficulty hiring teachers back because a lot of teachers think the teaching environment is not safe. So there have been a lot of issues there. A lot of restaurant workers are finding that. Let me just say that in general, it seems like a lot of the occupations where the problems are most difficult are lower paying occupations, where a lot of people have said, I'm being asked to take on a lot of health risk, and I don't think the risk reward is very good here. I'm not being paid very well. I'm going to try to find something else to do where I feel that at least the time that I'm investing, is being rewarded, or at least I feel safe. So I don't know how long this can go on. I mean, people built up a lot of savings during the pandemic. They did get some pandemic saving, from support from the government. So I think it's going to take a while. People are going to come back into the labor force. Also, we had a lot of early retirement. We had a lot of people who maybe they were eligible to retire, but they enjoyed working, so they kept working. And then when the pandemic came along, they said, you know what, I just don't really need to do this anymore. I'm going to actually take my retirement, or I'll take an early retirement. So we lost a lot of people from the labor force a little prematurely, all in a big lump. Those people might have left gradually over the next 2 to 3 years, but they all exited at the same time. So that's why I think it's going to take a couple of years for a lot of this.
How about the effect of the immigration laws? Because the work visas and immigration laws during the Trump era eliminated a lot of people coming into work in this country. And so the hotel restaurant industry that hired all those foreign students during the summer for summer vacation jobs, restaurants, hospitals who hired so many foreign nurses, all those people are not here anymore, right?
That's an excellent point, Debbie. And I think it will help maybe to answer some of the questions that many people have had about whether or not people who have come in from other countries are supplanting, taking jobs away from citizens in the US, right? Or whether these are kind of jobs that a lot of people are reluctant to take. And so far, I think, a number of employers are finding that, contrary to this idea that those jobs are being taken away from people, they're finding that there are a lot of people who don't want to do those jobs.
Especially in the construction industry, roofing, farming, all those are highly occupied by foreign workers.
Right. And so what we're seeing is that to get employees, workers are having to pay very high wages, in some cases offer benefits where they didn't offer benefits before. They're having to really pay up in the labor market to get people. And that's going to, prove to be a very good thing for people. But at the same time, I will say that employers are probably also really hard at work trying to figure out how to automate even more, a lot of the jobs that are currently being done, because they have these labor shortages and because they'll have to pay so much more to get people to come in. They're going to try to find different ways to organize the way they do their business. So that'll be a very interesting thing to see how it plays out over the next couple of years as well.
And interestingly, this $15 an hour wage that many people are getting now post-pandemic that weren't getting it before, if you're making $15 an hour here in Ohio, it knocks you out of child care support systems. If you walk in the door on $15 an hour. So people who would have gotten help with daycare are not going to get help with daycare with $15.
That's right. That's right. And there are a lot of shortages now in daycares. Daycares are finding it extremely difficult to attract staff. And that's an industry where, if you're in Ohio, if you're participating in this, quality daycare system where the state rates you and so on, you have to have staff that are trained and certified in early childhood education, and those people have to have education degrees, and they're finding that the pay is miserable, and so they also, as these centers shut down, now they're trying to get back open, but they're having a lot of difficulty finding staff there as well. So.
The other thing I was thinking about, we're facing the effects of every school across the country eliminating shop and home ec and various practical skills classes we used to have incorporated within high schools. So we don't have people learning those skills from like junior high school on when they had those classes. So if you're even more interested in the building trade, which is advertising a lot on TV now, you have to actually go to school to learn those building trades, because internship programs, or like, what do you call those? When you learn on your job.
Apprentice programs.
Apprenticeships. A lot of those apprenticeship programs have been eliminated and been turfed off to the community colleges, which means you have to pay tuition. You don't just get the training on the job. There's a lot of things that are a perfect storm for our current inability to find employees. In my opinion.
It's interesting that Elizabeth has a comment about job mismatch. She says, I'm interested in your comments on job mismatch. Many manufacturer jobs have used more and more robotics. How are workers who lack sufficient education, this goes along with Debbie's comments, going to make it in this particular culture and economy?
Yeah, I think one of the issues that we're going to see, it existed before COVID, but I think it's actually going to deepen over the next couple of years, is this sort of difference between skilled and unskilled people in the labor force. We have an economy which, there's a lot of, I mean, we're all interested in providing, we call, living wage, like working conditions where people are paid well. And if you're working full time, you could be able to support your family. But if you don't have skills in the labor market, it's really hard to find jobs that are going to afford, that way to live. And I think that what we're seeing in this environment is, again, employers are struggling to find people. They're going to raise wages and pay, but if they can't sell their products or produce their services at, ways in which they can make money doing that, they're going to look for ways to substitute machinery for people. And that's a process that's been going on, for all our entire lifetimes. I mean, it's not a new thing, but we're going to find, I think, that people who are really low skill, like you just have a high school degree and that's it, and you don't have trades, these trade skills, which are another, it doesn't have to be formal education, but it has to be skills that are valued in the labor market. And for people who don't have them, life is going to just be increasingly difficult. So I think we're going to see a further divide. We've seen that divide create lots of social issues in the country leading up to this. And I think, unfortunately, they're going to deepen because I don't see that divide. I don't see as a nation we've figured out how to help people get off that unskilled track, if I could put it that way.
What about the effect of loss of pensions? There's many industries, the coal mining industry, steel industry, all these people had great pensions. If they had jobs that were hard, they knew they had that pension at the end. Now we have 401ks now.
Right. Well, ironically, if you were fully invested in the stock market in your 401k, you're probably doing really, really well. Right. The stock market has been unbelievable.
But a lot of jobs have opt in and not opt out. So it's.
Yeah, I think that for people who are financially literate, the type of system that we have probably works fairly well. But once again, there are a lot of people who don't really know what would constitute a reasonable lifetime savings strategy. And it doesn't even have to be people who are, relatively uneducated. That's not really where the divide is. I know a lot of professional people who feel extremely unconfident of their ability to, manage whatever funds they have. And there are people who are not formally educated who are very, very good in the financial marketplace. So people should kind of recognize whether they, feel literate or not about that. There are plenty of ways to get help with it. But as you know, we have kind of a political divide, if I could put it that way, in the country about how much responsibility are people supposed to take for their own welfare, and how much do we want to ask the government to be responsible for doing that. And yes, we could have different kinds of pension laws that require various things where the government is sort of dictating how things are going to go. But I think, politically, we've decided to, in this country, at least for now, to trust the individual to manage their affairs.
I'd like to go back to one other aspect, something that we were talking about at the very beginning, the shortage of employees, because Ed has such an interesting question. He says, is there any historical precedent in the United States for the apparent change in labor supply? Has this happened before?
Wow. You know, we had the flu pandemic. I don't really know. I mean, I guess I would think when we had the flu pandemic, when was it, in the 20s?
2018, I mean,
20,
1918.
yeah, 1918, when that occurred, I would imagine it would have been the same thing.
Weren't we at war?
Yeah, or wars when, you know, a lot of working, you know, people who would constitute a big fraction of the labor force would go away. But of course, you know, historically, when we had those, that's what brought women into the labor force. That was you know, a big factor. So we had a big reservoir of people who were able to participate in the labor force. Culturally, they didn't. And then when we went to war, necessity brought them in. And that led to permanent changes in people's attitudes about women working. So we found ways to overcome that, I think. But in pandemics, it's different because it's really sudden and it's really broad scale. And so that's the only precedent I could think.
We have a number of questions about debt. So we know that debt ceiling's been in the news quite a bit recently. Should there be one? There are actually people debating that question. Should there be a debt ceiling? How will increasing debt affect the economy in the future? Can government prioritize debts and pay certain ones and then postpone others? And then we have a question from Chris. Where does Congress get trillions of dollars beyond taxes to fund all kinds of demands? And there's one more piece from Chris. What did Trump mean when he said that we'll get it back when announcing his approval of the stimulus payments in 2020?
Right. Well, I'll take the last one first. I mean, I remember all these, so I'll try to go as quickly as I can. The last one was, well, we'll have this big tax cut and it will initially lead to a lot of debt having to be issued because we're going to spend the same amount of money, but we'll have fewer taxes collected. But we'll get it all back because we're going to have such an economic boom in this country that everybody's income is going to go up. And even at the lower tax rates, the amount of tax revenue that will come in off of a much higher, you know, level of income that everybody's going to be earning. So the tax cut will pay for itself, was sort of the idea. And that was an idea that goes all the way back to Reaganomics, when Reagan proposed his tax cuts, and he and his group said it would pay for itself. It didn't then, and I don't think it would have ended up paying for itself in the Trump tax cuts either. The debt ceiling is really a bad idea, because the debt ceiling it just says we're not allowed to have more debt outstanding than X, like some amount that Congress sets, but that doesn't change the fact that we've already committed to spend a certain amount of money, and all those obligations have already been incurred. So it's kind of like the debt ceiling. It's like saying you've authorized all the debt to be issued and all the spending to occur, and then when you hit the ceiling, you're not going to pay it anymore. I mean, it kind of like gets in the way. So it's not a good thing to do. The right way to do it is to just not incur the obligations in the first place if you intend, you know, not to want to pay the debts as they show up. My understanding is that the Treasury does not have the legal authority to prioritize the payments. There's a lot of debate about this. They say that they don't, and that their systems are set up to just pay in sequence the bills as they arrive. and that's what they're going to do. And I think politically it would be a nightmare if they were to start picking and choosing and, you know, try to test that legally. Not only would it would be chaos, you know, legally, but people wouldn't know where they stand, and whoever does it would be accused of playing politics with who they're going to pay off and who they're not going to pay off. And I don't think anybody wants to go down that road. So, and where does the Congress get the money? Well, they just authorize the, you know, they say we're going to spend X amount of money. We kind of estimate how much taxes are going to come in, and then whatever is left over, the Treasury has to issue debt to finance that. So that's what I meant when I said they authorize all these expenditures. If there's not enough tax revenue, the government will issue debt. If there's a debt ceiling, they're not supposed to cross it, but they've already incurred all the obligations. You know, they've already legally obligated themselves to spend the money. So the debt ceiling, it kind of doesn't really make sense to have one if you are already authorizing the expenditures. They're going to push you past it. I don't know if that deals with all the questions that.
You have a wonderful memory. I think you answered just about all of those, except we really don't know how the incentive programs and the infrastructure programs are going to be paid for. You know, in terms of how are we really going to pay for them? And then how does it affect our future? That's one. How does having this massive debt affect our future economically?
Right. Well, the infrastructure program is a little bit easier to answer if the expenditures are really going to be on the kinds of things that are going to improve our economic environment, then they will pay for themselves if they're smart investments. And when I say economic environment, I can mean that pretty broadly. For example, if you think about the problems in Flint, Michigan with the water, those problems are evident in a lot of cities. It's a health issue. There's a lot of aspects of our infrastructure that are old and decaying. Climate change is certainly revealing some of the shortcomings that we have in the strength of our infrastructure around the country to, you know, deal with environmental problems. These are investments that we probably need to make if we're going to be able to keep up our productive capacity. I like to think of infrastructure, way of explaining infrastructure is think about if you have a computer and then you can plug into it all kinds of other things like a mouse or speakers or different kinds of large screens that you could watch shows on, right? I mean, there's a lot of things that kind of plug into a computer. And I like to think of our infrastructure as something that the private sector plugs into that enables it to be more productive. So if we have really good airports, we have really good roads and bridges, we have really good electrical grid, all those kinds of things, national high-speed broadband, if we did a really good job with a lot of those things, that enables the private sector to be a lot more productive in moving freight, moving passengers, providing all kinds of great services over the broadband system, right? All these kinds of things that businesses rely on. So I don't think of it as just public spending for nothing. I think of it as something that can really help the private sector be much more productive and profitable. So it benefits all of us. And there are a lot of, as I said, also health and safety issues that they don't always show up directly as a stronger economy, but they show up as a stronger labor force, workforce, healthier population. That saves us money over the longer run as well.
Here's an investment question for you, and then Debbie will ask the last question. It's amazing how time has flown by because there's so many things we'd like to ask. So the investment question from one of our attendees: given funds, should we buy bonds or stocks as investments for future retirement?
Well, that's something that is going to be specific to individual people. I don't feel comfortable giving investment advice. I say when people ask me about investment strategy, I say you have to be able to sleep well at night. If you've got your funds invested in a way that doesn't worry you, you're doing the right thing. So I think, talk to people who you think are pretty financially literate about your own situation and what you worry about and what you're trying to accomplish, with your goals. Sometimes it's a mix of both of those kinds of things, but the main thing is to be able to feel as though you can sleep well at night and not worry.
Good advice all around.
Yeah.
Debbie, do you have a question?
More like, do you have a final summing up thing you'd like to say? I mean, politics are such a big thing in this country that it's really hard to say what for the common good of our country would we do if we took politics out of it. Would it be your comment about the infrastructure, and how do we get there when in this world of politics, if that makes sense?
Yeah, boy, you're right that it does seem to get in the way of so much because there's so much potential. There's so many exciting opportunities with new technologies that could make people healthier and feel more fulfilled. And it seems like, I guess the thing that I worry when you would ask me what keeps me up at night, what do I worry about it? I guess I think I just worry that we're going to be so much at war with ourselves that we're going to debilitate our capacity to be successful economically. We have a lot of challenges around the world. And we're kind of beating ourselves up and not being attentive enough. I think we're taking on a lot of debt, to be sure. And we have other countries in the world who maybe don't have our best interests at heart. And, we need to stay strong and united as a people in order to deal with all of that. And also to take care of ourselves. We have so many fractions inside of our own country and divisions and people who are feeling that they don't have equal opportunities to move ahead. And that creates a lot of divisiveness. So yes, I think ultimately, our problems are, we look in the mirror and there we see our own problems.
Yeah. Well, thank you. It's been very interesting. It's just such a complicated situation.
Yeah, but times will get better. They will, and we'll all be able to be, I think, together again. And Zoom forums are nice, but it's so much better to be in the room together. And I think that will be hopefully sooner rather than later that we'll be able to do this in person again.
Great.
Thanks for inviting me. I enjoyed spending some time this morning with you.
Thank you.
And thank you, Mark, and to our very accomplished questioners for an excellent forum on the national economy. We appreciate your expertise and your commitment to our community forum. Next week's forum is titled Ransomware and Cyber Attacks. How am I affected? Speakers will be Christopher Pruitt, Chief Technology Officer, MRK Technologies, and Rocky Brockway, Chief Information Security Officer at Trusted Sec LLC, an information security consulting firm. This forum has been recorded and it will soon be available on our congregation website, uucleveland.org. We invite all of you to our service at 11 this morning. Today's topic will be on education in our religious community. Alan Georgia, our Director of Religious Education, will be the worship leader. We're meeting virtually as well as outdoors at our congregation's location on Shaker Boulevard at Belvoir Oval in Shaker Heights. Bring a chair, a mask, and be prepared to enjoy some great music. If you can't join today's service outside, please go to our website, uucleveland.org at 11 and click on the YouTube icon. You can also go to our Facebook page, Unitarian Universalist Congregation of Cleveland. We appreciate your continued support and look forward to seeing you next Sunday morning on Zoom at 9:30 for our forum on ransomware. Have a great day. Bye-bye.
Thank you.